The key to tactical asset allocation is the construction of a model that delivers short-term forecasts. With these forecasts, we will underweight or overweight certain asset classes and markets. The key to building a successful tactical model is having a very sound and stable model that delivers short-term forecasts. In this course, what we do is to develop models like this, whereby we use standard regression analysis to come up with a forecasting model. The research protocol for asset allocation, which is in the course, goes through a number of suggestions as to how we should build a model to minimize the chance that data is actually snooped. One thing that I require my students not to do is to use some sort of program like stepwise regression that will sort through hundreds of variables and come up with the best possible R-squared. Those models fail at a sample. What I actually recommend you do is to sit down and develop a short list of economic variables and financial variables that make the most sense for capturing the expectations of returns in a particular market. Each of these variables needs to be justified with an economic story. Come up with maybe 10 or maybe 15 variables that you think capture expectations of future activity in the economy or the health of the firm. Variables like interest rates are ideal because they are expected values already. The yield curve, yields on corporate bonds versus government bonds. All of these variables, like fundamental variables such as dividend yields or PE ratios, all look forward and are useful for forecasting stock returns. The key is to start with a short list of economically justified variables and end up with an even shorter list of variables for your actual model. Ideally, the model should have no more than 3 regressors in it, maybe 4. But as soon as you increase the number of regressors, then you will decrease the ability of the model to successfully forecast at a sample. The sort of predictions that we look at in terms of R-squared lie in the range of from 1 to 5, maybe 6%. So they're very modest in terms of the explanatory power. However, as I said previously, what we really care about is the directionality. Can this model pick up the direction that the market is heading?